Here are 5 potential multi-bagger stocks. Let's get into them right now to see if they are a buy at today's prices. Stock number 1, Google. Just 2 weeks ago, it hit an all-time high of $193. In the last year, it was as low as $121. And guys, back in November of 22, it had as low as like $83 a share. Now, Google's a great company, good return on invested capital, spits out a ton of cash and growing. It controls the 2 largest search engines in the world, Google.com and this very channel you're on right now, YouTube.com. That's how impressive they are. There's still a lot of potential worldwide. They're an advertising business. As the world becomes wealthier and wealthier, this company will make more money selling ads to more people. And the best part is, Google rewards advertisers who are more precise and who are more accurate about their pages by charging them less. So they could be the number 1 ranked ad and pay less than the 2nd ranked or 3rd ranked ad. Now, to go backwards 1 step, what's a multi-bagger? Well, a multi-bagger is basically a company that goes up X times. So if it's a 5-bagger, it went up 5X. If it's a 20-bagger, it goes up 20X. Chris Mayer wrote a great book about 100-baggers, and he made it sound pretty easy. What you need to get a multi-bagger is time and a great business. Don't think for a second that a company that goes 10X in 1 or 2 years is the automatic, you must buy this for multi-bagger. It's just a lot of excitement. Because remember, in the short run, stocks are a voting machine. In the long run, they're a weighing machine. To get a true multi-bagger that lasts decades, you've got to be able to buy companies that can grow on themselves, reinvest their capital to grow their business, and make it more profitable. Now for Google, let's go look at the 8 pillars and see what that's telling us. Guys, we got a company here, good ROIC, buying back some shares, which also helps become a multi-bagger. Cash flow growth of $30 billion over the last 5 years, $56 billion. Bottom line is no debt, nothing. This company has all the potential. Now, the thing about multi-baggers is they can appear to be expensive as you go along because you should pay more for good businesses that can compound on themselves. That's what's really important. Let's go check out these financials. Look at this cash flow statement. Now remember, guys, as part of our software, we add this cash flow, free cash flow line here, because cash flow is basically cash from operations less your capital expenditures. Go back 10 years, 12, 16, 25, 24, 23, 31, 43, 67, down to 60, up to 70. In the last 12 months, down to 61. But this company keeps increasing its free cash flow. And unless you think people are going to stop watching YouTube and stop using Google, I think this company has a very, very, very bright future ahead of it. Let's go see what analysts are saying about Google's earnings per share. Guys, look at this earnings per share growth. 31%, 13.5, 16, 15.5, 22, going from 780 all the way to 1440 per share. Okay, what about revenue? 13, 11, 10, 9, 10, going from 356 billion to 521 billion with a huge margin. So, like I said before, what's the right price? Well, when thinking about Google, you got to think about price fluctuations with all these companies I'm going to go through, because we don't know where the stock is going to go. It's important to understand that the fundamentals in the long run are what drive your accuracy or your ability to be right or wrong. Don't make your decisions based on short-term price fluctuations. Determine it based on your process and the long run. So, the right price for Google. Let's pull up Google in my history on Stock Analyzer tool. I'm doing a 10-year analysis. Guys, I'm doing 6, 9, and 12% revenue growth. Now, keep in mind here, guys, look at this ROIC. It's going up over the last 10 years. That's what's great to see. They're getting better and better returns on their money, getting to more moat status here. Profit margin. Guys, I think I'm conservative here. I did 22, 24, and 26. And the funny part is they did 24% in the last 5 years. But as time goes on, this should be a more profitable business. So I can understand if somebody said to me, no, Paul, your numbers are too low. This should be 23, 26, 29. Yeah, I could see that. Absolutely. And that's what's great about doing your own analysis. PE. I put 20, 23, and 26. What do you think the PE on this company will be 10 years from now? How immersed, you should pay more, you should pay a higher multiple for good companies and great companies. This is a great company. you got to pay a higher multiple. The market average is 15 PE and a 15 price of free cash flow. Guys, you shouldn't apply the average multiple for Google. That's absolutely a terrible idea. All these companies I'm going to talk about today, the vast majority, I think you should apply a higher multiple than 15. That's what's key here. And I did my 9% return. Remember, this is the market 9 or 10%. You've got to be able to put that margin of safety in there for an individual stock. So I hit the analyze button. Boom. I have a low price of 130, high price of 303, middle price of 201. I have it in my watch list at 150. So guys, even at today, if you believe these middle assumptions, maybe it makes sense here. So I might go sell some puts on this at lower prices, generate some income, and see how it goes. Stock number 2, Alibaba, another company I own. And by the way, guys, very controversial company. I own these shares. Don't buy stock just because somebody on the internet does. I'm here to show you what my viewpoint is on Alibaba, but you need to do your own research and come with your own determination because I'm trying to teach you how to fish. So, biggest company in China, the Amazon of China. It's been hurt a lot. All-time high 4 years ago of 320 a share. Got as low as 58 at one point. The 52-week low is 66. Great company, great cash flow. 5-year average free cash flow, 20 billion. Last year's free cash flow, 20 billion. Not a great return on invested capital, but enterprise value of 205 versus market cap of 194. That 11 billion is essentially their net debt. Guys, they can pay that off in 6 months. That's what's incredible about Alibaba. Now, what are the concerns about Baba? Well, of course, China. And that's a legitimate concern. There's still a communist party there. But remember, even communists love money. And over the last 20, 30, 40, 50 years, China has become more and more capitalist. Heck, they brought in Hong Kong 20 some years ago. That's the point for me. I look at it going, do I think China will be a bigger or smaller economy in the next 10 or 20 years than it is today? And I think it'll be bigger. And if I think it's bigger, who's likely to do very well with that? I think Alibaba. Now, there are other companies that'll do well with it, but I'm okay making that bet on Alibaba. Could I be right? Sure. A lot of value investors have gotten on board on the Alibaba train, and it's a tough play because there is a lot of negative news around that, but that's why the stock is so cheap. Because the negative news did not exist as much over here. And all the negativity I heard here all existed here. That's when I say news follows the stock price. All this negativity that was here existed as it ran up to there, but you didn't hear about it as much because news follows the stock price. So let's go see what the 8 pillars on Alibaba look like. All right, two X's, net income down, but we saw that cash flow is up. So it's just a matter of connecting cash flow and net income. I like seeing the fact that cash flow is up while net income is down, okay? Low return on invested capital. Could it have to do with growth pains? At first, Amazon had very low return on invested capital as they were growing. They're buying back shares. So when everybody tells me that, and this was a concern of mine, Alibaba was a fraud at first. Why are they buying back shares? They're taking cash to buy back shares on a fraud. Might be a really, really involved and smart fraud. Very well could be. 5-year price of free cash flow of 9.7. Single-digit cash flow for a company that has a lot of potential. Think about that for a second. Let's see what analysts are saying. Now remember, analysts have their biases. Not much growth. Is this part of bias or is this legitimate? I don't know. They actually have very little growth over the next 4 or 5 years. Ironically, though, they have much more revenue growth, going from 132 billion to 170. Still not huge, but if you pay a cheap enough price for a slow-growing business that might be inaccurate, I don't know, you can still do very, very well. As of June 30th, 2024, Alibaba had about $26 billion left of their repurchase plan. Guys, that is 15% of the company. And so far in 2024, in that first half, they repurchased about $12.5 billion of stock. Guys, this company is cannibalizing itself. This is a major key for major stock growth once the market starts to realize it. Because as they buy back those shares, they're going to split that revenue and profit amongst less and less shareholders. So let's go to Stock Analyzer tool. And here are my assumptions. Now remember, for all these stock analyzers, this does not include the balance sheet, which the balance sheet on Google's phenomenal. The balance sheet on Baba is phenomenal. I did 3%, 6%, and 9% revenue growth over the next 10 years. Profit margin, 15, 19, and 23. The last 15 years, now remember, their profit margin was a lot lower than their free cash flow. Free cash flow, I did 17, 22, and 27. PE, I did 16, 18, and 20. Now, the margin of safety is your desired return here. Like I said, 9 or 10% is the market average. So that's kind of telling me, Paul, this is what Alibaba should be worth to match the market. Your margin of safety will be a desired return higher than that. But this is to show me what is my current value based on today's numbers. Hit the analyze button. Guys, I have a low price of 125 to 140, a high price of 340 to 400, a middle price of 200 to 250. This is why value investors are intrigued, because based on today's price and even 3% growth, it's an 18% return if you were to sit there and these low assumptions occur. I wish I had 30 companies that match these metrics. I would love to buy all 30. Stock number 3 was the one I was just telling you about that just reported today, Sprouts Farmers Market. Now, guys, they just reported, crushed on earnings, crushed on revenue, have a great CEO that came from the 99-cent store, dollar store, or something like that, where his job was to maximize revenue per square foot. This is a company that has a little over 400 stores, and they've said their goal is to get to 1,200 plus. Guys, that's 3x times growth left over. Remember, it's a great company with great management. If the stock fell in half tomorrow, I wouldn't sit there and doubt the company. The company management are the exact same. Just because the market reacts a certain way in the short run does not make the company better. Unless, of course, your CEO is out there signing bras. More on that later. But I'm looking at this saying, this is a great company, a lot of potential locations. They invest about $2 or $3 million in each store. They're stabilized and cash flow positive and doing great after 3 or 4 years. This is a company that has a lot of runway. That's one of the biggest things we need for that multi-bagger. You need to be able to have a long runway so it can keep growing and keep growing. This company only did $7.2 billion in revenue on 400 and some stores. Do the math. In that meantime, could somebody come in and buy them? Yeah, look what happened with Whole Foods. Also, ironically, a stock I bought 20 some years ago, and you look at Whole Foods, they were bought by Amazon, crushed. Is it a different market? Yeah, slightly different market. But look at these margins. 4.5% in the last year, 4% in the last 5 years. Guys, typical grocery store does 1% to 2%. And on top of that, their own Sprouts brand is making a bigger and bigger chunk of their revenue. And those margins are even greater. These margins here overall are 37%. The Sprouts brand is 50 to 60%. And it's taking up, as time goes on, they're selling more and more of the Sprouts brand at higher revenue. Where's this profit margin going to be? Could it be 5 to 6% in the next few years? Yeah, maybe it could. That's quite the bull case, but it's not exactly out of reach here. This company requires a lot of conversation, and we have a lot of people in the community talking about that. And if you've taken a look at our community in software, you probably have noticed that we only have a limited number of daily spots for this community in software. And the reason for that is the software as it is today currently includes everything we have to offer about real estate, retirement, stocks, everything here. Behind the scenes, though, we are making some big changes. So that current offer of everything is going away very soon. Because as we've grown, we've been getting feedback from our community, and they've expressed they want us to focus on very specific aspects of the Everything Money tools that apply to them at that moment in time. Since we don't want to be the cheesecake factory of software, we have decided to limit the tools offered very soon so that our users aren't inundated with different offerings. You'll remember, since if you've been watching from the beginning, that I built the software selfishly for myself and my team so that we could use it to make better decisions in all aspects of my money investing. But the channel has grown immensely. The community has grown immensely. So it becomes less about me and more about how I can better serve you and the community members. Now, the good news is we have not made these changes yet. So if you join today, you'll be grandfathered in for life with all the tools. That means you'll get the tools, all of these tools, and every tool we make in the future forever, no matter what we change behind the scenes. This is the best deal we've ever offered. So if you're really serious about making better financial decisions, increasing your returns, and sleeping better at night, click on the link in the description below to get access to everything we have to offer before we make our changes. And I'm very confident it'll be the best decision you've made all year. So let's see what the 8 pillars tells us about this company. All right. Cash flow is actually down in the last 5 years. Isn't that interesting? Now, you will see one thing I don't like is cash flow in the last year is significantly lower than net income. But in the last 5 years, it's actually higher. So it's kind of interesting that we've seen a little discrepancy there. A little bit of debt. Obviously, retail locations has a lot of debt. I'm not as worried about that. decent return on invested capital as they still grow. And guys, like I told you, high earnings and free cash flow multiple. That's my big concern at $95 a share. But remember, great companies will appear expensive from time to time, right? Is that the case here? I don't know. So let's see what analysts think about the profit for Sprouts. Ooh, not very good. Analysts aren't very positive on this one. 315 going to 347. So I'm actually surprised by this. That's interesting. Even though revenue, they have going up almost 50%. 7.47 to $10.15 billion. Huh. Isn't that interesting? Okay, so let's go to our stock analyzer tool and let's figure out what would be the good price for me to pay for Sprouts. Now, I did a 10-year analysis. I did 6, 8, and 10% revenue growth. Profit margin, I'm going to adjust these now. I'm going to go with 4, 4.5, and 5%. And the same with free cash flow, because over a long period of time, they should be the same. Now for PE, I'm going to go 16, 19, and 22. Because this is proving to be a higher quality company that I think deserves a premium, especially with a lot of growth potential. So I'm okay paying up for that. That's my opinion. You might not agree with me, but I put the 9% return in, hit the analyze button. I have a low price of 56, high price of 120, middle price of 82. I had on my watch list at 40. There's my bias there because my basis is like 32 to 34. So I'm going to change this now. I'm going to put my price at $65 a share. Doesn't mean I'm buying it at 65. It means I want to be notified so I can take another look and potentially sell puts to get the stock at lower prices. Stock number 4, eBay. Now, eBay is a company I liked a while ago, but based on the way my views of what companies I want to own, it's changed a little bit. Here's my issue with eBay, but it might have some potential now. Because look at this. The revenue has started to fall, and now it's starting to creep back up a little bit. Last 12 months, 10.16. All of last year, 10.11. It did hit 10.4 in 2021, but remember, we were coming off of COVID. Now, the one thing eBay is doing great, go to the 8 pillars. Look at this. They're buying back a crap load of their shares. Their stock is selling for 11 times earnings, 16 times free cash flow, 13 times their 5-year free cash flow. And I have no idea why, but they're paying a freaking dividend. I think the play on eBay is if the stock goes lower, because I was interested sub 35, sub 40, as at those low prices, buying back a ton of shares. Even if the revenue and profit stay the same, buy back a ton of shares. That's what's going to get you your return. Let's go look at the income statement for the profit. Apart from this year, and apart from this year, that year, I mean, we have 2.5, 1.8, 5.7, 2.7, 2.65 for the last year. It's a lot of inconsistent earnings, but they still generate cash flow. And you sit there and go, okay, well, they continue to make this cash flow of $2 billion a year going forward, and they use all of that to buy back cheap shares. This could be a company that literally sells for 10 times earnings, but on a per share basis, the stock keeps going up. That's what's key there, guys. I think the play on eBay is buying back cheap shares. Now, is eBay a hard player in the market of selling things? It seems to have waned. It's more for specialty, things like baseball cards, rare watches, even autos are on there. But you look at it and say, okay, it's not exactly a growing, booming company. All-time high of $81 just a little over 3 years ago. Let's see what the analyst estimates are. I mean, look at this. Earnings per share on a ton. I wonder how much they're factoring in share buyback. 478 to 584, because look at the revenue. They have revenue growing at basically inflation, 2, 3.5, 4, 2%, 4.5. So not a ton of growth, but again, if they can grow slow and steady, and the other thing is, with a 72% gross margin, it's a big gross margin. That's significantly higher than Google. That's about or a little bit higher than Microsoft. If they can grow their revenue just a little bit and add that money to the bottom line, it's pretty solid. It's a great way they can sit there and take that cash, but I think they got to stop that stupid dividend. What a waste of money. It's absolutely a waste of money. 1.9% for what? If they just use this to buy back shares and that's it for the next 10 years, they're going to buy back 20% of the company, 18% of the company. 533 times 10 is 5.3 billion on 28 billion. They're going to buy back another freaking 16% of the company. That's the play here for eBay. So let's go see what eBay's worth based on these assumptions. And when was the last time I did it? Because I want to sit there and see what's the right price for eBay to be buying back its shares. I haven't done this company in a while, but look at these assumptions I made. -1, 1, and 3% revenue growth. 25, 30, and 35% profit margin. Because remember, they had a big gain one year when they spun off a business and sold it. So I can't include that in there. Free cash flow, I did 20, 23, and 26. I did a low multiple, 10, 13, and 16. So this is one of the examples of companies where I'm keeping a low multiple, even though their margin of safety, their return on invested capital is higher. And I'm going to put in my 9% market return. Analyze button, boom. Low price of 37 to 45, high price of 81 to 110, middle price of 55 to 72. For me, it's not the right price. It's on my watch list at 35. Maybe I add it at 40. I might change it to 40. That way I can sell puts at lower prices. Final company, and the big mamma jamma, Nvidia. That's what I meant by signing braziers. Guys, is this company start going decline, or is it going to new highs? Nobody has a clue. All I know is Nvidia is an incredible business. They've absolutely crushed it. And the fact that they still pay a dividend is absolutely the biggest joke of all time. $394 million. $80 billion in revenue. Guys, let's go look at their revenue growth. Let's go look at this. Let's go look per quarter. 7.6, 8.3, 6.7, 5.9, 6, 7.2, 13.5, 18, 22, $26 billion in revenue. Look at this. They did $26 billion last quarter in revenue. Let's go to annual. Guys, they didn't break $26 billion for a year until just 2 years ago. How incredible is that? This company's absolutely smoked it. Now, what are the risks for Nvidia? Because the stock goes up like crazy. Well, from a business standpoint is they make chips, and those chips are phenomenal. Back when I was a computer nerd, like back in the late 90s, we all knew Nvidia processors were the best. But they're not in an area that people can't compete with. They were just first to market. Does that mean they're not going to beat everybody? Of course not. They could very well beat everybody else. But the question you have to ask yourself is, what do they need to do to justify this metric? 65 times price of free cash flow, 61 times earnings, 197 5-year PE, 207 5-year price of free cash flow. This 5-year number basically doesn't matter anymore because they've grown so much. Is this a permanent plateau? That's where I sit there and say, I don't know what it is. It's hard for me to understand that. I like the slow and steady stuff. Even if it's a good rates of 10, 15, 20% growth, this was way more than that. Look at the revenue growth over the last 3 years, 61% a year, 5 years, 49% a year, 10 year, 34% per year over the last 10 years. But how much of it came in the last 2 or 3 years? So you have to ask yourself, is it easy come, easy go? Is it not? There's no denying it is killing it. Look at these cash flow numbers, guys. Look at all this cash flow this company is absolutely crushing on. This is the last 10 years. 780 million, $1 billion, $1 billion, 3 billion, 3.1, 4.3, 4.7, 8, 3.8, $27 billion. And in the last year, $39 billion. $39 billion in the last year. When did they do $39 billion in revenue? The first time they did it was was last year. So let's see what analysts think about these superstars. Look at this. I mean, look at this. $1.27 to $5.83. Still 4x growth on their earnings per share. 4x growth, double digit every single year, sometimes triple digits. Revenue growth. They're expected to double revenue again this year. They're going to 4x their revenue in the next 5 years. Guys, if they do that, this company's worth probably a little bit more than it is today. But that's the key. They have to get there before it's worth more than it is today. That's what I'm asking you. Are you willing to make that bet? A 5-year bet on that. Let's pull up our stock analyzer tool because I think it'll show you the interesting things about this company and the assumptions I made. 10-year analysis, 10, 20, and 30% revenue growth, 30, 40, and 50% profit margin, 20, 25, and 30 multiples, and 9% return. Hit the analyze button. We're basically at the middle price right now. So to justify today's value, it's got to grow 20% a year for 10 years at 40% profit margin. Is that possible? Absolutely. Is it probable? That's the question you have to ask yourself. That's what makes investing hard. And for me, I just choose to sit there and say, there's too much of a gamble there. I'm out. But more power to anybody who does it. Guys, if you want to see the 5 stocks I'm buying in August, check out our next video. And don't forget to sign up for the community at the link below. Thank you for your time.